everyone, I'm Haley Hodges with Utah Homes Network, and this is my really good friend Julie Jacobsen with Security National Mortgage. Julie is going to be with us through the duration of the 13-week program, and she is going to be our lending guru. Everything we need to know about lending, she is our person. So what are we going to do first? We are going to talk about the inevitable question or debate, I guess some people have with realtors and lenders, is who do you pick first? Who comes first, the realtor or the lender? So I'm a big believer in that you kind of need to know where your financing is at before you get the process started. But Julie, on the other hand, has a different take on it. And so I'm going to have her start first from a lender's perspective of who you should pick first, the realtor or the lender.
Well, Haley, I have been doing this a long time, and I have found that the realtor is who you're going to spend most of your time with. And if you don't have a good relationship with your realtor, this process can be painful. So I work with a lot of realtors. Can I say that?
You can say that.
Okay, start over. So I work with a lot of realtors, and most of my referrals come from there. When I do get a referral from a past client, they usually refer back to me and the same agent because they have found that we do work well together.
There's a good jive, a good combo.
And that works there. But whoever you pick first, it is important to get pre-approved before you start looking.
Yes. And so ideally, for someone that's never been through this process before, what does the pre-approval process look like? So you'll see in the program, we have a debt-to-income ratio form or worksheet that we want you to put together before you meet with us over Zoom for your consult. But with that debt-to-income ratio form, why is that important? What are you looking for when you're getting someone pre-approved to buy a home?
So a lot of people will go online and they'll find the little charts and they'll put all their information in there and they'll say this is what I can apply for. But there's a lot of things that might not be considered. So it's important that you've actually talked to a lender, they've pulled your credit, and then
when you meet with us over Zoom, you're going through all the specific details. That way Julie can run a full pre-approval or go through the process with you. That way we know exactly what you qualify for. Now, what you qualify for and what you want to spend are going to be two very different numbers. And the reason that I asked Julie to come and do this course with me is because we both believe in staying within your budget, not having you overextend your limits. And so it's very important to not only give us the numbers of what you make and what your debts may be, but also ideally, what do you want that mortgage payment to look like? Right, Julie?
That's absolutely true, and I would don't encourage people to spend their max, but also in this market, people need to be realistic. Mm-hmm. So if you come to me and say that you want your house payment to be $1,200, it's not going to happen. So especially as a first-time home buyer, and if you don't have a big down payment, so you need to be realistic. But again, that goes back to the early pre-approval process, because once you find out, you may not want to buy a house. You know, it might not be in your budget right now. So those are the things that we definitely look at.
Something to note there is then when you're talking with Julie, pre-approvals are only good for up to 90 days from when they pull your credit. So if you're knowing that you're not wanting to purchase until next year, we'll do kind of, what would you call it, Julie? More of like a soft check?
So we can run all the numbers. The only time if you're just outside of 90 days, I don't want to pull your credit unless you have a problem. If there's something on your credit that you're not sure of that we need to check out, then maybe we'll pull your credit. People get nervous about pulling credit. They hear it lowers your score. If you have a 750 credit score, pulling your credit is not an issue. If you have a 639 credit score, pulling your credit is definitely an issue, because 2 or 3 points can definitely make a difference in that spectrum. So it just depends on who you are. But one thing I like people to be aware of, if you're using Credit Karma, if you're using the credit score that comes on your bank statement, that is not the same credit score that I will see. So if you're not sure what your credit score is, then we probably want to look at it. Especially if we're looking at down payment assistance programs, because they have credit limits. So again, we just need to be sure. We don't want to put all of our eggs in one basket and then find out you don't qualify because we didn't pull your credit. So
now, touching base, and of course, we'll do another class specifically about the different types of loan options that people can opt into. But on average, and of course, everyone's situation is going to be different, but what is the kind of ballpark credit score? If someone was looking just to say, would it even be possible for me to buy a home? What's that lowest credit score that someone could be looking at to where it could be possible?
So if we're looking at an FHA loan, we can go as low as 580. Technically, if you have 10% down, we can go down to 500. But just be aware, if your score is down there, you will pay a much higher interest rate, and again, have to have the 10% down payment. So again, FHA, we can go to 580. Conventional loans, we can go to 620 if you don't have to have primary mortgage insurance. If you have to have primary mortgage insurance or PMI, then we would have to have a 640 to get that. But again, every 20 points, you're going to pay a different interest rate.
Okay.
So,
and then for those that may not know, with PMI, at what point do you have to pay PMI?
So PMI is for conventional loans, and you have to put 20% down to avoid that. If you don't put 20% down, we put the PMI in place, and it stays there and automatically falls off at 78% loan to value of where you purchase. That's the automatic point, and you'll know that at closing. We'll give you that date. But there are things that you can do to get rid of it sooner. With an FHA loan, your mortgage insurance is on the loan for the life of the loan. So regardless of how, if you owe $50,000, you're still paying mortgage insurance. But it reduces every year. So every on your anniversary date, they recalculate it, and your payment will go down based on the PMI.
Perfect. Now, I know a lot of times, I think especially for a first-time home buyer, the biggest things they're looking at is what's my credit score and what's the interest rate. And all you're hearing on social media right now is that the interest rates are so low, you need to buy a home. But what does that necessarily mean for people? I think a lot of times when you're looking around, if you have a great relationship with a realtor and they recommend you to a lender, oftentimes that's the route you go. But let's say you don't have a realtor right now, or you're searching for a lender. You see these billboards everywhere where they're marketing ridiculously low interest rates. Now, someone in the industry, I look at that and I'm like, where's the asterisk? Where's the disclaimer at the bottom claiming what the difference would be and that this isn't fully accurate? But for someone that doesn't know, what are questions or things to look for when talking with lenders when they're looking at the interest rate to make sure that that's in fact the interest rate and not something else on the backside?
So what you want to look for, if there's always a disclaimer, and
Right.
If there's not, then you just need to steer clear because they have to have a disclaimer. But usually what you're going to find when you see those interest rates is this is with 40% down, this is with a 760 credit score, and a $500,000 loan amount. If you're the rate, there's so many factors that go into a rate: your credit score, down payment, loan program, even the amount. So if you're borrowing $200,000 as compared to $250,000, there's sometimes a jump in the rate. So when you see the billboards or the bus signs or whatever comes across your phone, you want to look at the APR. That's going to give you a good idea of if they're charging fees. If the APR is similar to the rate, then it's probably a legitimate rate. But again, you have to meet all that other criteria. And if you're working with an online lender, sometimes they're going to have a lower rate. Not always. Sometimes they get those teaser rates in there, and like I said, if you don't fit the little box, you won't get that rate. And the problem you're going to have with those lenders is on the getting your offer accepted.
Yes,
they're hard to work with. They have wait times that are just unbelievable. So the rates sound good, but sometimes they're just not attainable. So. And most of the time, I can, if we need to, we can match those.
Mm-hmm.
They're not that different. So yeah.
No, and I always caution people: don't get sold by the flashy marketing. Do your homework. Look at the backside. Ask them for a breakdown of their closing costs and where all those fees are coming from. And if you have followed my Instagram for a while, you know that I always say, are you looking for Walmart or are you looking for Nordstrom service? And so don't get sold on the discount after discount after discount, because at the end of the day, your goal is to buy a home, and oftentimes if you're going a different route for saving the money, it actually costs you money more in the long run. And so you just want to look at those things. Not all the time, but sometimes that can be the case. So while we're talking about that and just different types of loans, let's jump into, just so people are aware of, how long realistically does it take from offer acceptance until they close on a home. So in this market, and I used to tell people you'd make an offer on 5 homes before you get one accepted. And that was, I would say, from 2016 to 2019, that was probably a good solid number. 5 offers and you'd get something accepted. Once, COVID-19 hit and the real estate market just took off, I've had clients, some people get offers accepted on the first try. Mm-hmm. Other people were on offer 25 and they're still not getting accepted. And so it's a completely different game now. But with that timing, I think a lot of people are still under the impression that it still takes 30 days to close and get a loan through to purchase a home. And in my experience, especially working with this one, we can go much faster. But what does that process look like? I guess with an FHA loan versus conventional, can they close at the same time, or are there certain hiccups that might take a little bit longer with certain loans?
No, the taxes. Conventional and FHA are going to be about the same. So you're going to give me an offer. The biggest time that we're waiting for is the appraisal. We have an agreement with all of the appraisers on our panel that we will get them back in 7 days, if not sooner. So I know, and that includes the weekend. So if I order it on Tuesday, I'm going to get it on Tuesday. If they can't do it, they're going to tell me that up front. So if we ordered it Friday afternoon, they might ask for a couple of days, or if there's a holiday or something like that.
But
so
that's lender specific, correct?
That's lender specific. Okay. So we don't use an AMC.
Okay.
We have an appraisal desk, so that creates the buffer between me and the appraiser, because I'm not supposed to talk to the appraiser. So we have a direct relationship with the appraiser. So the timing for an FHA and a conventional loan are going to be similar.
Okay.
Most appraisers that we use for those two types of loans are going to be they're going to be approved for both. So when we put an order out there, we have an agreement with the appraisers on our panel that they're going to have that appraisal back in 7 days. So that's not a concern for me. So what I do is I look at the contract. I usually will wait until due diligence is finished before I order the appraisal. If we need to hurry, then we order it before, but then the buyer needs to understand that once the appraisal's done, the appraiser needs to be paid for. So if something shows up in due diligence and you don't want to buy the house, we still have to pay for the appraisal. So that's something to consider. Once the appraisal's back, if we've done the pre-approval, we don't really need anything from you unless something's expired. So if your bank statement's over 30 days or your pay stub's over 30 days, we'll need to update it. But we know what to expect, so we're not concerned about it. We'll just get that updated. Once the appraisal's back, we go to underwriting. Right now, our underwriting is less than 24 hours. If I have it in on a Wednesday, Thursday morning, we'll have your approval back. We can address any conditions, and then we can schedule the closing. If that works for the buyer and the seller, then that's great. If not, if there's leases to be considered or moving dates for the sellers, then we can accommodate that as well. But technically, we can't close before the 7th day after your loan application, and we've done that. I did that last week.
But keep in mind that is lender specific. So Julie is just little Miss Speedy over here. I love it. We get things done really quickly. But those are things you always want to ask when you're going through the process, is making sure your realtor and your lender are on the same page. They understand the timing. I know our working relationship, anytime I'm about to submit an offer, I'm calling her and saying, realistically, what are we looking at with timelines right now? Are the appraisers backed up, or can they get it done in the 7 days? That way there's no hiccups. And that's the biggest thing you want, or I want to push all of you when you're learning this right now, is that all the effort and work you can put in up front is going to make this home buying process so much easier for you
sure.
if you do all the work up front. And especially what I love about Julie's process, especially with the pre-approval process, is you're giving everything to her from the get-go. That way you're not having to submit all these files 3 weeks in to the process. They already have everything they need to keep moving forward. And that's not the same for every organization that you would go to or look at. So these are just things you want to think about and ask when you're interviewing lenders. And then with realtors, ask them their timing, the relationships they have with lenders, and their communication style. I am a very upfront, candid, direct person. Doesn't work for everyone, doesn't jive for everyone. But and so you might want someone that's a little bit more timid and lets you take the wheel. These are things you always want to ask, because there's no one realtor or one lender for everyone. Everyone's going to jive with someone different, and these are things that you need to be aware of when you're looking to buy a home, because it's a big decision. It's a big purchase.
It is. Back to the timing, though. There's the VA loan. We kind of lose a little control with that one, because the VA has their own panel of appraisers, and they get 10 days, period. We are not allowed to call and bug and make any kind of contact until after that 10th day. So that's something that needs to be considered as far as the timing goes there. That's a little bit longer. And then the one loan program that we haven't talked about is USDA or rural housing. It's not as common because the areas that it's available in are restricted. But they have their own underwriting process. So once my company has approved it with a conventional appraisal, we have to submit it to the USDA for underwriting. So that can add some time too. And that, honestly, looking back over the last 5 years, that can be anywhere from 3 to 28 days. So, but that's something we know. They keep that posted on their website. So as you're making offers, if that's your loan program, we would know at the time you make your offer if there's going to be a delay there.
Okay. Perfect. And the one I think we haven't touched base on, but I know that social media and a lot of people are waiting for, they're not buying a home right now because they are anticipating several foreclosures coming onto the market, and they're wanting to wait for that to happen. I obviously don't have a crystal ball, but based off the data and things that I've seen, I don't foresee that, at least in the Utah market, happening anytime soon. But just for sake of education and people knowing, if you were to say, buy a foreclosed home, or you're putting an offer on a short sale, that is another process that is kind of out of our control in terms of timing, because it does go to the bank or to the courts first for them to determine if they want to accept that offer. And I have seen it take 3 months before they get back and give a response to someone. So those are just other things to consider in terms of timing.
And that's something that the seller has to deal with on their end. But something, and they would know up front what the timing would be, and if you're willing to work around those time frames, then it shouldn't be a problem.
Well, perfect. So I would say that is kind of touching base on the different loan options. So Julie, thank you so much for your time today. She is going to be back for other videos where we discuss appraisals, the pros and cons of HOAs. What else? Oh, my favorite. We're going to be talking about when you deposit your accounts, or Julie and I got to deal with one where I'm throwing her right now. She's not aware of it. Cryptocurrency, and just things you need to be aware of when you're making these deposits into your bank account. But these are all going to be coming up throughout the weeks. Thank you so much for joining us today, and we will see you soon.
Thank you.